This state fund now has $47 billion under management. ACC's investment boss tells us where it's putting its money to work and why he's sceptical of US tech stocks.
It may or may not be a bubble, but the people who are the early adopters aren't necessarily the long-term winners. We hold almost 5% of the free float of the NZX. We are quite a conservative investor, that's true. Of course there are other investors in the field as well. It'd be lovely to have it to ourselves, but we don't.
It's Monday the 6th of November and you're watching Markets with Madison. The ACC's investment fund is back in black with a 7% return in the past year, compared with the previous year's negative 9%. It's one of only two state investment management funds in New Zealand. It's $18 billion smaller than the superannuation fund. That could be because it's required to take less risk. Its portfolio is half made up of bonds, about a third in equities, and a bit in private equity and some cash. Paul Dyer has led the investment teams at both the ACC and Superfund in his career. We caught up at the ACC last week and started by talking about tech stocks. Good to see you, Paul. Thanks so much for doing this.
Thank you and welcome.
I want to talk about US stocks first. You have a near $1 billion allocation the fund does towards Microsoft, Apple and Alphabet, which is the parent company of Google. But there was a quote in your annual report that seemed a little bit sceptical about whether or not that run up in their valuations will continue. Why are you potentially dubious about it?
The US market's been driven by a few large, particularly tech stocks at the top in recent times. This is Nvidia, Tesla, Friends, Alphabet, so on. Okay. Now, there's a lot of optimism amongst investors that these stocks are leading their field and that they're dominant and that they'll earn returns accordingly from that. And that may work out to be the case, but history tells us that where there's technological change going on like that, it's hard to capture it all, and that the people who are the early adopters aren't necessarily the long-term winners. You know, we look back to the previous tech bubble 20 years ago, that pattern's very prevalent, and bubbles before that as well. So it's the decision that we delegate to our external managers who are the experts at it. But when we look at the choices they're making, they've generally tended to be light on those stocks rather than heavy, and we can understand why.
So they've told you that they've purposefully excluded stocks like Nvidia, for example?
Yes, at one point none of our managers held any Nvidia stocks. We've got 8 global equity managers. So they collectively made a decision this is fully priced and acted accordingly.
But the positive returns on valuations on stocks like Nvidia have been going all year. So shouldn't they, in hindsight obviously, which is always a lovely thing when it comes to investing, but shouldn't they have at least tried to make a buck within that hype?
At ACC we're conscious that we deliberately take a long time horizon. We're here to fund the cost of accidents that occur over many, many years. What happens in the next few months is more or less of less importance to us. We're much more concerned by buying investments that we think are going to support our long-term investment objectives. And stocks where there's a speculative element to it we're a little bit more sceptical of.
You say sceptical, does that mean that you think it's a bubble that's going to burst? Would you go that far?
A bubble, it may or may not be a bubble. What we can say is that when stocks prices have run up as sharply as some of these have, that the odds of getting a full cost of capital out of them in the next periods are diminishing.
New Zealand stocks, you have a larger equity allocation to them, but they haven't been doing as well compared to US tech stocks. So why are you still so heavily weighted towards New Zealand?
Well, few companies have been doing as well as US tech stocks in recent times. You're right, we hold almost 5% of the free float of the NZX. Now we do that because it suits our purpose. We're here to fund accidents that happen in New Zealand, liabilities that are denominated in New Zealand dollars. So we've got a definite home bias as a result of that, and that stems back to the purpose we're investing for.
Isn't your purpose to make better returns longer term, not keep the NZX in business?
No, our purpose is to help fund the cost of accidents. Will an investment we make ACC a better place to pay for the cost of accidents that have already happened, or won't it? And that's the screen and the criteria that we apply to everything we invest in.
But when it comes to better placed, I mean, isn't that ultimately all down to making more money, to have to fund those future cost of accidents?
Well, it's about risk and return. If we had a crystal ball and we knew what the returns were going to be, we'd put everything in the highest returning asset. But we don't, and nobody does. So we have to be prudent about where we're going to invest. Okay, and And that tells us that we should diversify, but it also tells us that we should skew towards assets that we think are better and more attractively priced.
Bonds is one of those. You have almost half of your entire fund allocated towards bonds and especially inflation-linked bonds. It's not that fun that you just have to focus on fixed income. I guess that speaks to really the lower risk that you're able to take because of that mandate, does it?
Yeah, we are quite a conservative investor, that's true. But again, that comes down to our purpose. It wouldn't be good. We want to make sure that people who have got long-term injuries know that come what may, ACC is going to be there and able to fund them and pay for the cost of their care well into the future. Remembering that a lot of our long-term injured can be on the books for very long times, 20 years plus. So that guards us against taking too much investment risk.
Is it frustrating in a way that liability that is your mandate, you can't control? All you can control is sort of the market risks. Even to that degree, it's limited, isn't it?
Yes, when you say control, obviously we can't directly control the cost of accidents that are going to happen. What we can do is partially hedge some of those costs. I'll give you two examples. One of the costs that causes our claims costs to go up over time is just straight inflation, particularly medical cost inflation. Okay, and we can partially hedge inflation. We can buy assets that are going to go up in value when New Zealand inflation goes up. Principally, inflation-linked index bonds are good for that, and we own a very large swag of that market. In addition, a big impact on the cost of claims comes from interest rates. If discount rates go down, it means we're going to earn less on our funds, all else being equal, which means we're going to need more capital over time to pay for the cost of those injuries. Now, we can hedge that by taking positions in our fixed interest portfolio, and we do that pretty actively.
Bond yields are blowing out, especially the longer term dated ones. What do you make of all of that? Is that crazy to you?
Not necessarily crazy. What I would say is that we consciously take a 20-year horizon when we're thinking about investing. What happens when we have gyrations like we've had in the last few months is of lesser importance to us. We've got a time horizon and a size. We can just look through that and kind of take it in our stride and keep focusing on what we're here to do.
Your allocation to inflation-linked bonds obviously has helped protect a lot of downside risk in this high inflation environment. A lot of people think it's going to be harder to get down to that 2%. What's your thoughts on where inflation is heading, Paul, if you could give me some?
We still have all our holdings of inflation-linked bonds, but that's primarily because we're uncertain about where inflation is going to go. There's a credible line of thought out there that inflation could be high for quite a long time. We don't know that that's the case, but we do know that if that does eventuate, it's going to cost us in terms of claims costs. Therefore, we continue to hold our inflation bonds as a hedge against that scenario coming out. And really, that's just investing 101. You've got some objectives. Life is uncertain. Diversify. Okay, it's no different for ACC than anybody else in that sense.
Markets are certainly uncertain at the moment because the world is in a very uncertain, unstable state. How much attention does the ACC pay to what's happening in the likes of China and the US economies?
Oh, we certainly watch them and think about the risks that they may entail for our investors. I'd say, though, that I can't remember a time when the world economy wasn't uncertain, and I suspect it always will be. What we're thinking about is if we invest today at today's prices and put our capital into those markets, what sort of longer-term returns will we generate from them? And that dictates where our investment goes.
I want to talk about infrastructure because the ACC clearly plays in this space, not as much as your friends at, say, the super fund do because their mandate allows them to take a bit more risk. But what future do you see for the ACC playing in infrastructure, particularly now that we have a new government and they want that infrastructure deficit filled? Could you use your balance sheet to do it?
We've done a fair bit of infrastructure investing. We've done it in roads with PPPs. We've been at Pukoi Walk and Transmission Gully. We've funded wastewater plants in Wellington. We've funded student housing here in Auckland. We've funded, helped local governments who want to do subdivisions. All of these stuff are types of infrastructure. It's a really varied sort of field. What I would say is the common element that all of them have got is that we want to be able to generate an adequate risk-adjusted return on behalf of the ACC schemes. As long as we can do that, we're fully open to infrastructure investing. That
sounds like you're limited, though. It sounds like that risk-adjusted return is harder to get in that space, is it?
No, it's not actually harder to get. Probably, if anything, the field is constrained by lack of opportunity to invest, not by lack of willingness to invest in it. Okay, if there were infrastructure deals or any other kind of deal that offered us adequate returns for the risks involved and was going to benefit the purpose for which we exist, of course we'd be open to investing in it. We'd be mad not to.
What kind of return would you expect on funding more infrastructure?
Oh, how long's a piece of string? No,
Is there a type of infrastructure that you expect to pay off more in the long run than
another? The answer to
another?
that's no different to infrastructure than it is for any other kind of asset. When we hold in the funds a whole range of assets from the lowest risk cash and bonds to the highest risk private equity, let's say, okay, we want adequate compensation for risk, and that means the required return is going to be quite different depending on the type of asset that you're talking about. Okay, if we can find infrastructure or any other kind of assets that are well priced for the risks involved, then yes, we'd be interested in them.
Can you give me some examples of ones that you think would provide a better return? Is roading perhaps more profitable than student accommodation?
Oh, you can't generalise like that. It depends on the particular details of the transaction that you're talking about. It depends on who the counterparties you're dealing with are. It depends how much leverage is involved in the transaction. The devil's in the detail in that. You just can't generalise.
It's a crowded space though, right? I mean, you're now competing with, the super fund for one, but also BlackRock wants to spend money on low carbon infrastructure here. I mean, how do you compete with those guys?
Okay, of course there are other investors in the field as well. It'd be lovely to have it to ourselves, but we don't. It's a competitive market for investing. Competitive markets are generally a good thing. It means the crowd on the other side are going to be getting value for money, and that's how it should be.
You're a career investor. You have been in this game a very long time. The super fund before you came to the ACC. You've also advised former finance ministers. Who do you look up to in the investing world?
It's a cliche, but I'm going to say Warren Buffett. Now, he's an unusual individual in that he is fundamentally a good businessman. He's running what's a very complex business in Berkshire Hathaway at the moment. But he also understands markets and understands them extremely well. And that combination is rare. In my experience, we find people who are good investors, we find people who are good businessmen or economists or leaders, but they don't always overlap. You don't find those skills bundled in the same person. And when you do, they're truly exceptional.
He's a value investor on paper. So is that something that you sort of like to follow as well, value investment plays?
We try not to be permanently a value or a growth investor per se. Why? Because both of those styles have their time in the sun for a while, and then it'll reverse. And we haven't found investors to be particularly good at anticipating that in advance. Okay. Therefore, we think we're better off concentrating on finding investors who are fundamentally good investors and not worrying about the style factors so much. We control them and make sure we don't get the allocations and the risk get out of control, but we don't bet the house on it.
I'm sure you have a view on this, but I always like to ask the question whether or not you think markets are efficient or not. A value investor's answer would be, well, no, they're not. Otherwise, there wouldn't be value to be made and had. Do you think they're efficient?
We believe markets are largely efficient. And people who think they're inefficient are probably relatively new to them and haven't had the hard learning experience that goes with it. They must be fairly efficient. There's people around the world looking for suitable investments, and that's going to force a degree of efficiency. There's always going to be people who've got exceptional skill and can do better than markets over a long period of time. They exist, but in our experience, they're comparatively rare and unique, and hence very valuable when you do find them.
47 billion in assets under management that you look after every day. I can only imagine how stressful that is, but you probably try and park it in the back of your mind when you walk into work, Paul. What do you think ultimately makes a good state asset manager?
Well, I think what makes a good manager for the state is no different than what makes a good investor overall. People who are balanced, who are intuitively good at taking risks, who understand what they're doing, who are not over-complacent or overconfident, who are well-read, who are seasoned in what they do, but also passionate about it as well. Few investors regard it as a hobby that they kind of put down when they get home at night and pick up the next day. They're thinking about it, driven about it, excited about it all the time, and that's a great thing.
The question from my audience was, what can this incoming government do to help support and grow the ACC investment fund, perhaps make it better and bigger, other than direct capital? Is there any function you think they could improve?
I'd better stay clear of that one.
Are you sure?
A bit pointed.
Now's your time. What would you like?
No, I don't want to give the government advice.
Thank you so much for your time, Paul. Appreciate it.
Well, it was fun.
He didn't show much of it, but Paul is actually a pretty funny guy. I'm hoping next time we'll be able to get some of his quips on camera. And thanks to Brad for sending in that question for him. I typically post on Twitter who I'm interviewing next, so if you want the chance to chip in, go and follow me on there. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.